What's up, everyone? This is the drill down for June 7th. I'm joined in the studio with David Giustizia of Vision Capital. Big news coming today, and that's why we're here. Bank of Canada announcing a 25 basis point increase as Canada's economy was stronger than expected in the first quarter of 2023. Got some notes here from Bank of Canada talking about exactly why they raised those rates, specifically citing GDP growth of 3.1%. BOC mentioning that consumption growth was surprisingly strong, even after accounting for the boost from population gains as well as demand for services that increased. In addition, spending on interest-sensitive goods increased, and more recently, housing marketing activity has picked up. The labor market does remain tight, and while higher immigration and participation rates are expanding that supply of workers, new workers have quickly been hired, reflecting continued strong demand for labor. Overall, excess demand in the economy looks to be more persistent than was anticipated. So, David, why is it important to make this hike right now for the Bank of Canada? And do we think this could be the end of what we're seeing, or could this be the start of another set of rate increases like we had last year?
Yeah, Mike, it's an interesting discussion. I mean, the market sentiment over the last 3-4 months has been tremendously volatile. So we've had this period of time kind of through the end of March, April, where market sentiment was largely leaning towards an expectation that inflation was trending in the right direction. Everything that we wanted to happen in regards to our market kind of turning back towards normal was moving ahead, and that we would start to see the first round of rate increases as early as rate decreases, as early as the end of this year, perhaps early next year. In the last maybe 3 weeks, we've seen this huge spike, this huge change in overall market sentiment. And so the expectation, the inflation numbers, like the GDP numbers, like you mentioned, this continued growth, this kind of about face in the trending direction of where these things are going, really put most of the economists back on watch to say, hey, look, we're no longer anticipating rate declines this year. They started to price in expectations of rate increases. Right up to just before the rate hike, I think we were at about like a 40 to 50% expectation that we'd actually get the hike today, that we did. But there was a 100% expectation that we were going to get a hike at some point this year.
Yeah, a lot were calling for December for that hike. They didn't figure it would happen this soon in the year. We'd get some more data points first before making this decision.
Yeah, absolutely. And I think for Bank of Canada, what we've seen from them lately is this change in mentality around like sooner's better, right? Mm-hmm. They would rather, in my opinion, what I'm seeing from them now is they would rather be a little overzealous, move a little too quickly, rather than risk that they move too slowly. Mm-hmm. And so, do I think this hike was necessary? Who knows, right?
It's debatable. I mean,
there's definitely pros and cons, like from a macroeconomic scale on how this is going to trickle through. I think more importantly than the actual 25 basis point hike and what that means for rates, what that means for mortgage rates, all that kind of stuff, I think it's more of a signal of kind of the broader picture of the economy. I think it's more about consumer confidence, because I think one of the things that we saw over the last 3 months is we've seen in many real estate markets a very large pickup. Burlington, I think I had some numbers from one of our realtors recently. I think Burlington saw like a 9.6% price jump. Hamilton saw 2.6, and not quite as aggressive. And so that was partially influenced by, the bond yields coming down, the fixed rates stabilizing for a lot of buyers in the like mid fours for the past few months. But I think a lot of that also came from consumer confidence, right? This level of confidence that, okay, Bank of Canada did the last hike in January. People watch them ride it out a couple hikes, no movement. It's like, okay, like we're at where we're going to stay for a little bit. And so a lot of that can spur this consumer confidence piece. And I think one of the big impacts of this hike is going to be shaking that up again, right? Shaking up that idea that like everybody thought we were maybe done in January and that was the peak, and at some point we'd start to trend down. And now it's like, hey guys, that may not be the case anymore.
But why don't we want, you mentioned the consumer confidence piece. Why don't we want that consumer confidence? Because I would think that's what we want. We want a healthy, confident economy of consumers that are not overspending, but happy to spend. Why do we want to taper that down?
Yeah, so that's a great point. I mean, consumer confidence drives ultimately decision making, right? For me, getting away from kind of the academic versions of how they play that out. For me, consumer confidence is about, oh, I was on the fence. Am I going to buy that boat this year? Am I not going to buy that boat this year? Right? Are we going to buy that cottage? Are we going to make that big purchase? Are we going to take that family trip? Um, One of the problems with consumer confidence is, to your point about healthy spending, is like overspending, right? It's driving that extra push. And one of the things that we've seen that is combating against this inflation decline is that people's habits aren't changing.
Mm.
We're not seeing the type of pullback that the bank would hope for
Okay.
based on where we've moved rates, based on where things have gone. We're still seeing, everything getting super expensive, but consumers are still spending on it anyways, right? And so that ultimately, from an inflation perspective, the higher that demand stays,
Mm-hmm.
the less likely it is that we're going to get that inflation back in check. And so for them, I can see a world where shaking that up, getting people to take a second thought on that next big decision
Mm-hmm.
is going to help them change that level of consumer confidence, and in turn perhaps help them change what they want to change about our GDP growth and about our inflation metrics.
Yeah, it seems like I totally understand what you're saying. They want to tamper down that spending that's happened, but I wonder if it's been too long of living the good life for Canadians. Canadians, I believe, are some of the most in-debt people in the world when you look at, dollars per dollars income earned. Does this, sharp pain, is that enough? Does it need to be more of that long drawn out kind of thing? Should people expect that the Bank of Canada is going to continue keeping things where they are, I guess, long term, and not really? I know a lot of people go, oh, eventually it'll drop back in a year or two. We're going to be back down. Rates will drop, everything like that. But to your point, we really need to get things under control that have been out of check.
Yeah, and I think there's a couple things that have driven that. I mean, cheap access to capital for extended durations of time have certainly contributed to that, right? And we've definitely seen some peaks and troughs throughout the interest rate market over the last decade. But I remember back in 2016, there was mortgage rates in the low twos, and then we kind of started creeping up towards like that four range, and then they kind of dropped back down, and then we had the COVID drops and that kind of stuff. And I think this idea that like everybody was expecting at some point this reversion of the new normal for a long time became mortgage rates between kind of the two to low threes.
Mm.
And when, your cost on borrowing $1 million is 20 to 30 grand a year,
Mm-hmm.
your incentive not to do so
Mm-hmm.
is pretty low.
Yeah.
Right.
Yeah.
And it's cheap money. And I think where I think I see Bank of Canada going, I mean, are we going to see another rate hike this year, or are they now done completely? Who knows? I think at this point, even Bank of Canada is being pretty transparent. They're going to react to the economic data. They're not going to sit there and do what they did years ago during COVID, saying like, hey, we're going to keep rates low for long. And they're not going to make these like absolute judgment calls. It's going to be, we're going to continue to respond to economic data.
Mm.
One of the things I would say from at least my personal outlook is that I think we will see this state of elevated rates stay here for longer than many people hope and expect.
Yeah.
Right. And so I think this idea that, to your point about the long drawn out pain, if they start dropping, we saw as soon as those rates drop, like on the fix and the bond yields in the spring, the flurry of activity we saw from that was insane. And I think that's like really indicative of what would happen if they start pulling prime down.
Now, with this rate change here, what does that mean for two things I'm going to ask you? What does that mean for your average Canadian household? But then what does that also mean for investors? And the reason I ask is because it feels like everyone and their mother has since jumped to a fixed rate out of variable. Last time we met, we were talking about nobody searching variable anymore when it comes to those homeowners and people looking at mortgage products and lending products against a property. What does this mean now at 25 basis points? Is this a big jump? Is this going to be the final straw to push people into fixed? Or what are you thinking is going to occur from this now?
I think it a little bit remains to be seen. I mean, in our database and with our clientele, we're working on some communication stuff that's going to go out tomorrow, this included, to kind of talk about the impacts of this. From a raw data metric, I mean, it equates to, depending on your amortization, about $13 extra per month per $100,000. So like, is it the final straw for some people? Maybe. For most people, probably not. I think it's more indicative of that like duration of pain, right?
Okay.
I think there's a lot of people who have adjusted their lifestyles. There's people that I know in our world that have taken on like secondary jobs to kind of keep things going, all with this expectation, all with this like forward looking guidance that like we're going to ride through this pain and it's going to be over soon.
Mm-hmm.
And I think the bigger change here is rather than kind of the nominal effect of a 25-point increase, it's like this pain might be here to stay a little longer than what we expected. And so I think the change for homeowners is really going to be the same as it always was, right? Reassessing the situation. Does your current debt strategy make sense? Do your current mortgage products make sense? Lines of credit from this, like, so the expectation prime will be at 6.95,
Mm-hmm.
which means like your typical home equity line of credit rate is going to be at 7.45. So you're almost looking at, 7.5% on revolving debt. Many people use that to overspend through COVID and to take on new purchases and cottages and down payments on houses and cars and all sorts of things. And so as that climbs, just a review of that debt strategy and revamping what that looks like, I think is going to be important. And it's going to be very much a personal decision. As it relates to fixed rates, it's always, for most people, it's the gap that's important, right?
Mm-hmm.
So if I'm in a variable today at, let's say I was 6.5%, now I'm going to be at 6.75. If my prevailing fixed rate in the market was, like it was, let's say a month ago, on switches, depending on loan to value, we're getting like 4.59, even for uninsured refinances, I was seeing sometimes as low as 4.7, 4.8. When you have that kind of like 2% spread, the inclination to make that jump, pay that penalty, or do that conversion, whatever you need to do to get into that fixed rate, is pretty strong, because it's like, well, how many rate drops would we have to have for that not to make sense? And the answer is probably more than we're going to see. Now, with what's going on, the 3-week run up, we saw about a 0.5% spike in the bond yields. We saw another 20-point spike in the bond yields today.
Mm-hmm.
And so what's going to happen, and what's already happened largely, but what's going to continue happening based on the rate movements from today's yield change, is that spread between variable and fixed, it's collapsing again. We're not getting the same kind of discounts by going fixed that we were 2-3 months ago. Mm. And so the closer those numbers get back together, the more likely it is those that are already in variable, are going to hold on for the ride.
Mm-hmm. I know you've always been a fan of variable more than fixed rate. Was that due to a long-term kind of just modeling out you're going to do better on variable? And I know we've talked about as well that it's not just about the interest you're going to pay when looking at a product and determining between fixed and variable, but seeing that rates have gone up today. Also, you just mentioned the bond market, bond yields popping back up. And actually, why don't you tell us a bit about that? Bond yields coming back up too today. I think everyone's focused on that Bank of Canada rate increase, but what's going on with bond yields?
Yeah, so I think the bond yield story kind of starts a little bit before today. So, as we went through March, tail end of March, April, better part of May, we saw a continued decline. We saw bond yield stabilization for the Government of Canada 5-year around like the 3%, give or take, 10 or 15 points. And so that drove fixed mortgage rates back to kind of the mid-4s for the most part. And so that was a really welcome change by a lot of borrowers who, even like first-time home buyers, like kind of coming into your first home, it's like, okay, mid-4s mortgage rate, that seems like a more normal number than kind of the 5s and 6s, right? Mm. Over the past 3 weeks, after some of this GDP and inflation data came out, investors were already anticipating some of the commentary the Bank of Canada put out today, right? Some of these numbers were stronger than expected, stronger than probably some people hoped. Mm-hmm. And so what we saw is we started to see this big uptick in the bond market, right? And so incrementally over the last like 3 weeks, we've seen the bond market move up. Like I said, probably before today, almost about like 50 basis points, give or take. So we went from kind of a 3-ish GOC 5-year to about a 3.5 GOC 5-year. And so that meant that the fixed rates have been climbing through that period. Sometimes I've seen some lenders changing rates as much as, 2-3 times a week. And so through that, there was kind of a mad scramble for people to like rate lock and pre-approvals, all that kind of stuff. The big piece of news today, I think, is that we saw the size of jump in the bond yields that we did, because typically on a lot of these Bank of Canada rate announcements, there's been many cases where we actually don't see any change in the bond yield after the announcement. There's actually been a number of cases where the Bank of Canada announcement was to increase rates, and we saw the bond yields decline.
Okay.
Right? And that, to me, is indicative of the overall market had priced in that expectation, right? And the release from the Bank of Canada roughly met that expectation. So, although it might be news to Canadian, it might be in the front page of the newspapers, and to the average person, this is the day that they're getting their information, right? When it's kind of publicized all over the place. The investor market, they had already assumed that this was going to be the case, and their yields and their trading decisions were already reflective of it. When you have a spike like this on that announcement, what that tells me is that that was news to some investors. Some of the guidance that Bank of Canada gave today was not expected.
Yeah, and last time we met, we talked a bit about how Bank of Canada was being more transparent and more communicative about exactly what they were doing, what their plans were. Now I'm wondering, with this kind of correlation between two separate things, but both, I don't want to say interdependent, but adjacent to one another, are we thinking we're going to get additional communication from the Bank of Canada and better insights into the next 6 months ahead?
Yeah, I think it's going to be hard to tell. I think, the next release in July is going to be the one where they release like a little bit more information.
Yeah.
But I do think that, like, based on the release today, they were pretty transparent. And I think they've kind of taken the approach from here on out, at least from what I can see, is that it's like, we're not going to predict our decisions. We're going to make decisions that are reflective of the economic data we receive. If data is trending in a direction that we like, and GDP is going down, inflation is going down, then we're going to hold, maybe at some point start decreasing, right? If we see inflation picking back up, we see core inflation not moving, we see GDP growth stronger than expected, then we're going to raise. And so I think Bank of Canada is going to not really be in a position to kind of provide the forward-looking guidance, because it's the forward-looking guidance is ultimately we're going to watch the data and we're going to react to it.
Yeah. And that seems actually like the healthiest form of government agency we could have, unlike many others. We're going to wait, we're going to assess, and then we're going to make movement based on what the market dictates versus making these broad strokes and doing things that are crazy like that. So then I'll ask you this, because a lot of investors, modeling out what the future looks like for them, trying to look at doing something. If you're not a high volume investor who's dealing with someone such as yourself on a regular basis all the time, got to ask, a year ago when I was modeling out some properties and looking at some things, when I was looking at variable rates, we're like sitting around 3.5%. And I said, worst case scenario, we're probably going to 5.5 points. We're much higher than that now. If you're an investor today looking at buying, we'll leave fixed rates aside because that's kind of a different thing maybe, but like, where should that investor be modeling out that top end now? Is there even a smart place to model out that top end when looking at variable, or is it, anybody's game and just look at other things now when modeling out an investment decision?
Yeah, it's kind of hard to say. I mean, the two things that we've seen, and I don't know if we talked very much about this, but in the kind of run through COVID, it's been a bit of a double hit, right? Because not only have we seen the prime rate increase, but we've seen the spread against prime shrink, right? So if I kind of think back a couple of years ago, kind of peak middle of COVID, prime rate was 2.45. On average homeowner loans, we were probably getting an average of like prime -1. So your 2.45 on prime was really like 1.45 on the mortgage. Depending on the lender and how competitive they wanted to be at the time, some of the investment and rental properties are maybe prime -0.7, prime -0.8, prime -0.9. Now we've seen that spread shrink to 0 or almost 0. I think we have a couple lenders that are like prime -0.3. I got a couple lenders that are like prime plus 0.4. So we're really straddling like 30 basis points or so on each side of prime, with prime now being probably at 6.95, right? So we're kind of looking at like high sixes to low sevens. And so I think it really it's going to be really hard to predict at this point what additional moves Bank of Canada might take. My general suggestion is, we're obviously somewhere near the top of a rate market, right? It's very clear we're not sitting at the 1 or 2% that we had. So I wouldn't be asking investors to be working on massive buffers, right? But, buffering in a 0.5% or 1% is probably never a bad idea. Yeah. And then also looking at, fixed term options and seeing what's out there, because there are still, as of now, at least, opportunities kind of in the mid fives. Maybe after these bond yield changes will be kind of closer to the upper fives. But in many cases right now, like, you're still getting at least a % discount to go fixed, right? And so the question really becomes like, does it make sense to run on these variable models? The big thing for variable before was the exit strategy, right? It's understanding that, you know, you can break it with a 3-month interest penalty and not have to pay that IRD. I think the big risk for people to go fixed right now is that if we do happen to see a really substantial decline in the rates, um, you may have some really massive break penalties if you have to get out of those mortgages.
Yeah.
Right. And so I think that's probably the biggest risk across the board in going fixed is just understanding that like you have to be more intentional. You have to have a better understanding of what your entire investment strategy is. And if it's like you're going to take a 5-year fixed term or a 3-year fixed term, you got to be pretty confident that you're going to ride that out.
Yeah. Speaking of riding it out, just turning to our short-term rental friends and some news that came out. We're filming here in Hamilton, right in the heart of the Hammer, downtown Hamilton, and I think some fortunate news when it comes to Airbnb and Airbnb policy. The city announcing that they've just got too many priorities to focus on right now when it comes to housing, and their stoppage on the Airbnb rentals for if you don't live there, it's not your primary residence, you're not able to rent out that property as an Airbnb. They've stopped that and since turned to saying that they're going to be focusing on rent evictions 100% of the time. Have you heard about that?
Yeah, absolutely. So that was supposed to take effect. I believe it was last week that the bylaw was supposed to come into play there. And for clarity, it's not that they're retracting the bylaw or the changes to
Correct.
that. It's simply that they're dedicating the enforcement efforts out elsewhere. So the implementation of that is being delayed at this point. We don't know how long.
They put it on pause. That's what they
But
said.
yeah,
It's on pause
on
for other
pause.
priorities, but we know what that means with the government
Yeah,
sometimes, right?
exactly. You know, I think from the Airbnb side, really no big surprise, right? Lots of other municipalities have done it. You know, the short-term rental market, everybody kind of touts that as like a big problem with the housing supply, that these properties are being used for short-term purposes. Personally, I mean, there's two sides to that. Like in some situations, they are correct. Like there is obviously, if you're dedicating a home to Airbnb, it means that it
Yeah.
can't be a long-term rental. I think the flip side to that is there's obviously demand for that, right? There's obviously people that actually do need those services.
Yeah.
And you know, the setup of hotels and the setup of existing rentals aren't necessarily meeting the demand. And if they were, and they were able to do it more cost effectively, ultimately Airbnb wouldn't have a market. And so it really just comes down to like, I think for that, finding the right balance as an investor. I probably wouldn't be reliant on that. I think people, you know, there's a lot of people I saw that kind of got burned. We saw little city up north, tiny township that they got kind of the Airbnb shut down and all through cottage country there, where a lot of investors, their investment property, their investment cottage only made sense if they could do that. As soon as they can't do that, the numbers kind of completely fell apart, right? And now they're underwater. And so, you know, making an investment decision that is contingent on something as finicky as, you know, one little piece of government policy that we're already seeing changed across many townships in Ontario probably isn't the right play.
Yeah. Yeah, the whole Airbnb thing I find a bit interesting when you talk about it, right? You mentioned there's obviously demand for it, which when we were just talking about that Canadians are still continuing to spend. It's kind of funny how that correlates. There's still Canadians taking staycation vacations. I do find it interesting that there's the policy that came out about it, but the government is still also offering you tax benefits if you took that staycation. I remember my accountant calling me just last tax season going, "Did you go anywhere, even in Ontario? Did you stay at an Airbnb? Give me the receipt and there'll be a tax benefit for it." So some, I don't want to say conflicting messages, but conflicting policy, I guess, in terms of what we're supporting and what we're not. But overall, I think saying that the Airbnbs is just the main issue for supply, or such a big issue for supply. I think there's a whole lot of other issues. I know we've talked about it. We've said we talk about it. You know, we don't want to talk about it because everybody talks about it. But as a reminder for those that don't know, yes, the government is reporting 400 to 500,000 new immigrants coming to Canada every year. That's permanent residents. That's PRs coming. You got another 800,000 students, 200,000 workers on visa. Of those 800,000 students, 65% of them will be staying behind after the fact. It's great. We need the help. We need the tax revenue. But I think there's a lot more problems to it than the fact that, you know, my buddy down the street owns, you know, 2 vacation rentals in the Muskokas.
Yeah, absolutely. And I think when we get into the supply problem, like I think, you know, you get this news focus, you get kind of what's flashy, what's going to create clicks. fundamentally, I think the biggest challenge we have isn't about like these little pieces of niche markets, right? Like,
Yeah.
oh, there's 100 Airbnbs or 200 or 300, whatever the number is in any given municipality that are taking away potential long-term rental stock. I think part of it is just the ability to create housing that meets the demand, the
Mm-hmm.
ability to create housing that meets the needs of the local population
Mm-hmm.
is starting to get more and more difficult. And as you continue to bring in people, they need somewhere to go. And if you can't find a way to fix kind of the bigger picture problem, that's going to spiral into something, a lot more severe than, whether or not somebody's allowed to rent out a property as an Airbnb.
Yeah, and speaking of that, the headlines and people talking about, there's a lot of the catchy, flashy kind of pieces that come up. One of the more recent ones that I saw down here was the federal government announcing an investment of $180 million into Hamilton to build 500 homes. But as we touched on a little briefly before we got rolling here, when you do the math on 500 homes at $180 million, you do that math and break it down and say on average it's 1,000 square foot unit. You're looking at about $350 per square foot to build out of that. And you go, you're just not going to scale that. What's $1 billion going to get you,
Yeah.
right? Where are you going to scale that and build that supply? And what I come back to is I think the rhetoric publicly needs to shift from vilifying those that are actually trying to invest in rental properties or trying to invest in building homes. And that needs to shift. And we're really not going to be able to fix any of these supply issues until we start figuring out a way to leverage these hungry investors, people that want to do these things, and turn around and say, hey, here's the benefits for you. They tried to do that with MLI Select, but I think MLI Select was too out of reach for your average investor. That average person has a duplex, triplex. Like your average person doesn't have a 12 unit or a 15 unit that they can afford to do 60% of the units at an affordability metric or something like that. What do you think about that?
Yeah, I think there's a few things. I think, you can kind of break it down into different geographical areas as well, right? Like I was chatting with one of our partners that's, quite a large investor, and we were talking about like the potential to build these modular fourplexes, and they were kind of costing out these models, and it was in like a tertiary market, think like, 2, 3 hours outside of the GTA. And ultimately it came down to like their cost to do these things was about 250,000 a door. So it's like, okay, so you build a couple fourplexes, you're $1 million. That's not including the land. It's not including the servicing. So, in those markets, those properties aren't worth $1 million, right? So if your total cost, even if you get pretty cheap land and servicing, like you're 1.3, 1.4 to build a fourplex, you're now underwater, right? And so I think one of the biggest problems that this rate market has created, that this inflation has created, is that creating new rental stock in a lot of markets is no longer a profitable venture. There's no incentive for private investment to go do that because ultimately the cost for them to create that product is higher than what it's going to be worth on completion. And so any, savvy investor is going to recognize that that's not a venture that they want to go into. The only places where the fundamentals do make sense is where the rental prices are higher, where the per door values on completion are higher, which is obviously in the more urban markets, right? Primary markets. And so I think that's part of the concern around this like population density piece in the influx of new population into Ontario is like until they can kind of figure out how to support those people that want to do these things, until they can figure out how to help the private sector make it at least modestly profitable to undergo that venture, we're going to continue to be supply constrained, especially in secondary and tertiary markets, which means it's going to push more people into the GTA, which is going to further push prices. It's going to further push demand. It's going to further push all these other things. We have so much land in Ontario, but we have so little places that people actually want to be, right? And so I think it does create this like bigger picture problem from the segment of MLI. Like I think the government was really trying to focus on getting retail investors, getting your average investors away from buying things for families that they could own and live in, right? So the idea behind it was like, let's incentivize the people that are creating like larger scale rental stock.
Okay.
Right? Nobody's going to go buy a 12-unit apartment building to live in a unit, right? That's like purely an investor play, but somebody would certainly buy a duplex to live in it or a single family home to live in it. And so I think that was like part of the attention in that separation is like, let's try and incentivize the development of like new larger scale rental stock and keep investors away from, the single families and the duplex and the triplex. But I think the other challenge that you have with that is there is rental demand for those homes, right?
Yeah.
There are people always love to vilify like investors who own that single family home and they rent it out, or they own that duplex and rent it out. But the reality is, no matter what price point, there is people that would like to rent, and they would like to rent a home, not an apartment. And so there's always going to be some balance that's required in the market between those people providing services that people want, like a single family detached house to rent, and so that has to balance out somewhere. And so kind of vilifying an entire class of investor is probably not the right approach.
We want our cities to be these world-class cities. We've talked about places like Toronto and Vancouver, and everyone wants Toronto to be a world-class city. And I've said to people when they talk about housing prices in Toronto and the inability to actually purchase a home in Toronto, and I'm going to rent for the rest of my life, they'll say, congratulations, you now live in a world-class city. Welcome to the club. Because the New Yorks and LAs and Londons and Parises and Tokyos of the world, you're renting. And I think a lot of Canadians now are going to have to realize that path towards retirement that included your principal residence as being, that's going to be that nest egg. It's time to start shifting that rhetoric around there and looking for other ways to plan for retirement than we did previously. And I hate to say that, the hope of owning a home for your average person is maybe gone. I don't think it's gone. I think there's still ways to get there, but I think it's time to start looking at some of those European models in terms of this is the future. And I agree with you. I think there's people that want to rent that single family home, because buying a $1.4 million home that I can rent for $3,000 a month is a big delta that we're talking about now, right?
Exactly. And I think, as we continue to see that rhetoric change, as we continue to, from the people in the financial planning world, like helping people understand that you can be successful, you can have a great career, you can have a great retirement, and you can do all of that without needing to necessarily get into home ownership. A lot of it comes down to personal choice. And so finding a way to balance out all of that, I think, is going to be really critical. But ultimately, even the people that don't want to own a home or can't own a home, they still need a place to live.
Yeah.
Right. And so that rental stock piece is still critically important.
Do you think that model that's happening in Toronto right now, where they've opened it up for those single-family residences to be converted up to, I believe it's 4 units within the same piece of property, do you think we're going to start to see that branch out to other municipalities, whether it be in the GTA or across Canada? Or do you think that might just be a Toronto, maybe Vancouver, because of how high those populations are within those cores?
I think it would be beneficial to a lot of municipalities. I mean, it's whether or not we're going to see it, I think remains to be seen.
Yeah.
But the problem with that in other municipalities, kind of coming back to what I was saying about some of these secondary, tertiary markets, is the fundamentals of that don't necessarily make sense everywhere, right? Because in Toronto, you build that carriage house and it's renting for $3,000. Well, if you build that same carriage house in Chatham, it's renting for $1,300. The cost to build that carriage house is the same in both places.
Yeah.
Right. And so this idea around like intensification, when you're in areas where the rental rates are really high, the fundamentals can make sense. As we get kind of further and further and further from the central GTA, even if they did allow it, in many cases, it's not going to be a sensible choice for homeowners or investors to make that decision.
All right. So if you're an investor, you're a homeowner, you're out shopping for a new home, you're out shopping for a new mortgage product, rate holds. Tell me a bit about rate holds and why that's important when looking at these things.
Yeah, absolutely. Thanks, Mike. So I think with rate holds, it's really important for people to understand that should really be your first step. Like, we've seen such a volatile market lately in terms of even the fixed rates bouncing kind of all over the place. The ability to kind of collect some really preliminary information for us as brokers and put a rate lock in the system for you. What that does is it's basically insurance against future rate increases, right? So this can be applicable in a whole bunch of situations. It can be applicable for a first-time buyer that's out shopping for a home. Rates 3-4 weeks ago were as low as like the mid fours. We still got a couple lenders at like 4.94. Those rates in 2 days could be 20-30 points higher, right? So our ability, without having to go through necessarily even a full pre-approval, we're not even screening all the way to ensuring that they can qualify. It's simply like, hey, let's get the application and let's get the bare bones skeleton of data that we need to get a rate locked in the system. The rest of it, we can kind of tidy up later. We can go through the income validation, down payment validation, figure out what the next steps are to be able to make sure that you can actually acquire. But once we get that rate hold in place, we know that, hey, our rate's not going to be higher than this. If they do come down before we buy, you still get to take advantage of that. This is also really applicable to people who are in a variable looking to convert to a fixed, or people who are looking to refinance, right? Sometimes it's just about, getting that preliminary information in the door so that we can get that rate hold in the system. And then maybe we have the deeper conversation about, well, does this really make sense? Do we want to refinance? Which debts do we want to roll in? Does the variable to fixed conversion make sense? All of those things take time. And depending on where the bond market goes, in the time it takes to make that decision without a rate hold, rates might be up 0.5%, right? And so it can be really valuable for people to get that rate hold in place, get that locked in to make sure that they can then take the time to make the proper decision and not be rushed into something, but also not lose out on the best rates available.
When you say get that rate hold locked in, I know you've called me before later in the evening. We think things are going to happen. Get that rate locked in. People ask me, because I've helped them out before, because you call me, I call them. Am I locked in now with that lender? Now that I have a rate hold with a lender, am I locked in with that lender, or do I still have the ability to move around after the fact?
So you're not locked in, but the ability to move around is going to be really contingent on what happens in the market. So for instance, I put a rate hold for somebody in 4 weeks ago, 4.59 on a 5-year fixed. Well, the best rate in the market today is 0.5% higher than that. So are we locked into the lender? Certainly not. Can we make a strong case to not use that lender? Also probably not, right? That's kind of the whole purpose is to set that hedge, set that top end. And then if something better comes along, great, we'll change strategy, right? But in that moment, we kind of can look at the rate sheets. We usually get a little bit of notice. Some of my lenders will usually email us around like 2-3 p.m. and say, hey guys, rates up at midnight. The bond market is really indicative of this. If I watch bond yields rise, I know that within like 24, 48 hours, most of the lenders are going to bump the rates up. So we usually get like a little bit of forward notice, like very little forward notice. But the thing that I can say to kind of the average homeowner, the investor, is that if it's something you're looking at, a refinance or a purchase, like the sooner you can put a hold in place, there's no real downside to it.
Does having a pre-approval with that rate hold strengthen your buying power, especially as your average home buyer when you make an offer, in terms of adding some sort of weight behind that offer?
Yeah, I think there's two things to that. I think, from the ability to submit a pre-approval with your offer, does it strengthen the offer? Kind of depends on the situation in the market. Okay. Again, it's never a bad thing, right? It's never going to weaken your offer. But what I can say where it can really strengthen people's offers is on your purchasing power. So one of the things that I've seen happen is, buyers are out shopping or they've started shopping, but they haven't really taken the time to do like the mortgage piece yet. They know they're well qualified. They're not really concerned about, the ability to get the mortgage. As those rates rise, their qualification amount slowly degrades, right? Because every time we get those rates up, every time those fixed rates are a little higher, the amount of debt that they can borrow goes down. So for people shopping right at the top end of that budget, the other huge benefit of the rate hold is it's going to crystallize that pre-approval amount. It's going to make sure that, hey, today you're shopping for 700. 3 weeks from now, if you call your broker, you don't want to hear them say, okay, you can't shop us for 700 anymore. You're shopping at 670. Right? Because rates went up. So unfortunately, your ability to qualify for debt has now come down. And so having that hold in place is going to like crystallize that qualifying criteria.
Going to end here and say thank you to David Giustizia from Vision Partners for joining us today, June 7th on the Drill Down here in the heart of the Hammer, downtown Hamilton. I love it down in the Hammer, my Hammer people who are watching. We'll keep coming back and we'll keep trying to make sense of what's going on so that you can make sense of what's going on, not getting caught in the headlines. Once again, thanks to David Giustizia. That's the Drill Down for today. See you later.